Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. We can't look at this, guys. Like, my strategy is you buy it and you hope that you gotta get spotted. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Well, we had an interesting week with the Federal Reserve meeting last week. Now we're coming into end of month flows. Might be a quiet start to the week, but I do think that we could have some interesting things happen. And of course, there's always that possibility that if we get some elevated activity here today on Monday, that it could carry through to the rest of the week. So let's just kind of see what happens. I got a video we're going to post here today. So there's a couple of little final details on that I need to work out here. But before I do that, let's go into the charts. Okay, so we do have a rollover here. MTN, that's mini TN. Okay, so here we got the treasuries. On Friday, we saw a little bit of, some hawkishness in the treasuries, and here today we're seeing it again. And this seems to be coinciding with the S&P 500 really starting to try and, recover. Now, I should also note that next Tuesday, is supposed to be Liberation Day, as Trump has now named it, when tariffs go into effect and Americans are no longer being ripped off, etc., etc., etc. But for now, S&P 500 seems to be okay with everything. So, okay. I still kind of feel like that interest rates are a little bit too high. But I digress. Here's oil. Oil in a pretty good but very gentle uptrend here. Could be just, pull back for next big drop, though. Gold took a little bit of a hit on Friday, but they are retracing a lot of that. Here you can see just a little bit more extreme in silver. Kappa taking a big jump over the weekend, actually. I don't know if you can see it very well, but there's a little tiny jump there. And the Japanese yen, the Japanese yen gave up some of its gains from last week. They're kind of back towards the lower end of this. But again, as long as we're in this area, that's totally fine. Anything too crazy happening in the Japanese yen could be really bad overall, so we don't want that. And the Bitcoin, pushing almost, 88, almost 88. So a little bit of a jump in cryptocurrencies over the weekend. Let's just come here to the daily charts again for a second. Okay, so there is some long-term support here in the treasuries. And the S&P 500, not quite to like my mean reversion areas. Okay, so from our perspective, that does not give us a lot of flows to work with, though, unfortunately. Fortunately, that does not give us very much flow to work with. So we're not having any kind of like CTA levels or anything like that on the charts coming in is what I mean by that. Let's come in and look at the calendar for this week. You'll see it's fairly short. So here today we do have a manufacturing PMI, or the flash PMIs. Those are relatively significant. We're going to have plenty of Fed speakers this week. Tuesday, we get new home sales and CB consumer confidence. Durable goods on Wednesday. Thursday, we get unemployment claims, of course, and final GDP quarter over quarter. That's a relatively significant. So that's probably the biggest one this week. And the core PCE, that's also a big one. Because that's the Fed's favorite measure of inflation, right? And then you revised University of Michigan consumer sentiment. So it is, but it is a little bit, these are kind of like B-tier economic releases. So, but I do think we could see some Donald Trump speaking. So that could lead to some turmoil, right? Something I do want to mention is I'm seeing an interesting take in conservative media concerning the Ukraine situation. And what I am seeing is this. Used to think that, Donald Trump is maybe perhaps being influenced by Russian propaganda. He seems to admire Putin to some extent or something like that. And why is he being nice to Russia, right? Well, conservative media are now saying that a key part of the administration's geopolitical strategy is to separate Russia and China. Now that is an interesting take. That is something that I have missed or I haven't heard. Now, is that coming from the administration? This is like all of the sudden I'm seeing a lot of conservative social media type people talking about this. So that could maybe be a better explanation for Trump's behavior, is if he thinks the real geopolitical threat is China and he wants to isolate China politically or geopolitically or however you want to put it, then you take the L on Ukraine so that you can pull Russia away from China's orbit. And then you put tariffs on the Chinese economy, which was already kind of hurting, still kind of hurting. It's interesting. I saw this thing on Zero Hedge there saying, oh, China, we're seeing US go down and China go up. And I'm like, well, I mean, not really. China's still hurting in the bigger picture. But who knows? So the reason that that's important, though, is that kind of means that if they're correct, then that means that tariffs, at least in regards to China, are not really a negotiating tactic. Like I kind of think it has to be a negotiating tactic to some extent with Canada and Mexico and everything. But I'm seeing some market participants start to shift to be like, this is not just a bunch of bluster to try and negotiate a better trade deal. He wants to isolate China, wants to decouple and then isolate China. Is what they think that the direction Donald Trump is going in. And I must say that whole kind of theory makes sense to me. So if that is the case, I think that he will probably continue to be, we'll continue to have that run up and that we will have tariffs go into place on next Tuesday. I don't know. And how will the market handle that? Like, right? Because right now everything's like, oh, okay, it was bad, but we'll live. I need to remember to turn my algorithm on here. Okay, so now that I got all that together, by the way, good morning, Ray. Let us pull together my video I have to watch here. The review. Windows Media Player tried to sell me on something that I didn't actually need there. I'm liking what I'm seeing already because it suggests to me that my video editor understood the content of the video, and I'm seeing that in the visuals that he chose. So that says to me that I did a good job delivering the message in this video that's coming up. Couple of spelling mistakes he made in here. Oh, I love the picture. Hey, Paul. Okay. So that watched that. I look so old in this picture. I don't know. I think we can go with that thumbnail. You think that thumbnail is okay, guys? We'll see. That billion needs to be like, it needs to have a T on it though. Trillion. Should be like 14 trillion. At billion. So this is, billion is such a small number compared to trillion. I think with that should give us a good, I don't know. It doesn't seem clickbaity enough to me, but I don't know how, how to amp it up. We'll go with that for now. Wow, there's some bad spam in the Discord overnight. Good morning, Ann Steffa. Mm-hmm. Go, folks. No, good morning. Hey, yeah, good morning, Gus. You know what? This has been the slowest start to the 10-year treasury in a month. When was, do you guys remember that day? There was a day, and I would say it was this year, where it was super tight, and the opening 30 minutes was only a 6-tick range. 1, 2, 3, 4. This is technically a 5-tick range, although I would say it's probably a 6. 26 has gone off, it's just nothing hit it. That is tight. Good grief. Morning, Octavius. By the way, do we still have the live financial markets and economic commentary? We keep it with that. I kind of like the idea of, I don't know how much it matters. I think that the thumbnail and the title are probably the biggest things that you get going for you in terms of like getting a streaming audience on YouTube, but I don't know I think there is a limit to how good it can get. But I do like the idea of just having that in the title, because I feel like that when I have it all focused on day trading, that everybody assumes that I am going to teach you a strategy that's going to make you a millionaire. That must be what he's trying to do. And it's attracting the wrong audience. We want an audience that is interested in the economics of it all, really, because you got to be an informed trader. Like the best opportunities are going to come from informational asymmetries. And when we just go into the day trading space, all day traders all think that means that we're going to look at charts and trade some sort of chart pattern. Well, I do have a chart up. I have one chart over here that's the dollar. And then I have another chart that's over here that is an algorithm. Mm. I'm talking to my video editor, and he used the word, and I'm like, what is this? He's like, oh, sorry, I meant this. And now I'm like, wait, what's that too? I think that you auto-corrected an autocorrect. Tight market. The video that I'm trying to put out, or we do have to make a couple of changes, just spelling mistakes, is a really important video, I think. Complexity economics is a field of study that I think is well suited to addressing the unique challenges of our time, and answers why, or rather it can address some of our big economic failures of the last few decades. So we really want this idea to gain more traction. And the thing is I did my best to really try and hit home how important it is and to really grab people's attention. And I hope it did a good job, because it's not just that, but this is probably my best chance to really have a video that really builds and grows the channel. Like it's the most important video to me, and I just hope it works. Because we're to the end of my rope here. I'm not sure if I get one more unemployment payment next week or not. So either this one or the next one is the last one. And I'm worried that whatever I end up picking up for my next job, I'm worried will prevent me from being able to do what we've been doing here on the channel. Actually, I had a recruiter for a bank reach out again. Now I shouldn't be too concerned about it, because when you're reached out to by an external recruiter, there's a lot of, they will talk to you and even like interview you, and then like the hiring manager isn't interested or something. I don't know what happens, but I've had a lot of those where you talk to them and then nothing happens, but it was somebody from the bank, and I'm like, oh yeah, if I did that, I don't think I'd be able to stream anymore. But kind of have no choice. Not a lot of jobs posted last week either. Really, there was like 2 jobs that I was interviewing for. I really thought I had a really strong chance of getting. One of them, I don't think they hired anybody. And I'm kind of pissed, because like all the feedback that I got from them and everything was really positive. So I don't know what I did wrong, but I think that they decided, no, we're not going to take this guy. And the other one, I'm sure it was close, but they didn't go with me. And then since that time, not a lot of openings posted. Yeah, in fact, when I come over here and I look, I see a bunch of jobs that like just keep getting reposted. You took a long in UB? Why? Oh, sorry, it's Octavius. When it's that narrow, man, I do not take a trade. For some reason, I thought it was D that said that. I was definitely like, why would you take a trade on that? Bad idea. Here's one. Why long? Oh, because it broke out of the top of the range. That's probably why he's looking at it. Although I would have kind of considered 26 the top of the range, so. So Octavius kind of has like a more mechanical. He's always, whatever that range is, he's always taking it. But I really do not recommend trading the treasuries in this kind of a market. When it gets that tight, even if you do get something, you're not going to get very much. Like it seems like, volatility compression. That means that when it does break, we should get a good break, right? But it usually doesn't work that way in the treasuries. In the treasuries, if it's not moving, there's a good reason it's not moving. There's no reason for anybody, institutions to trade, and that means that the possibility for a trend is very, very limited. Why not play it like a straddle? Oh, well, probably because you only have outrights over here, right? Otherwise, he kind of is. You would set a stop at 27, and you'd set a stop at 20 to get in on the break of it, right? So for that, I think he has his at 26. The 10-year moved on the outside of it, not CB, so. What's the rhythmic symbol for UB? Oh, I think it is UB. Let's see if I can find it. Yeah, it's just UB. Oh boy. Is that saying narrow range gap downs on Tuesday through Friday are unreliable? I would say anytime that the 10-year treasury is extremely narrow range for the first hour, that there's not a lot of opportunity. For only the first hour or any hour period? Well, I mean, if it's like that for the first hour, then it's probably going to be like that. But it's really, you can really tell within the first 10 to 20 minutes, actually, of the regular session in ZB. Or sorry, ZN is what I'm usually looking at. If that first... So it starts at 8:20 Eastern time, so that there's 10 minutes before the news, because a lot of economic news is released at 8:30. Okay. So if in that first like 35 minutes or something like that, you know, if we get to 8:45 and we're still within a 6-tick range, then yeah, this is going to be a slow day. And I wouldn't even look at it like, okay, let's try and program a strategy that says when the range is under this much, don't do anything, yada, yada, yada. You should be able to anticipate it. And in fact, if you go back to the beginning of this stream, you can go and watch it on replay. I was identifying that right at the very beginning. I was like, well, we have lighter economic news this week. It's probably going to be a tighter day. If something happens, like if Donald Trump comes out and says something, then you can get increased volatility, and then like all bets are off, right? But in terms of like predictable flows that we have, there is not really anything, and so I would not expect there to be very many, if any, institutional players at all coming in and doing things, and hence there's no reason to trade, and so the 10-year just doesn't go anywhere. And that's the real thing, is like, can you predict what the volatility is going to be based on your predictors of order flow? And in this case, we did. I expected it to be pretty slow day, and so far it has been. And I wasn't using some bizarre, combination of patterns or anything like that. I'm just looking at our predictors of order flow and saying there's not really anything there, so we shouldn't see much movement. If in that first 10 minutes we had moved like 8 ticks or something in a trend, I would have been, whoa, hold on. There are big players here in the market. Maybe they're expecting big changes or something. Like, I would immediately be triggered, like, okay, something's going on, right? But Robert F. Kennedy Jr. has announced plans to ban pharmaceutical advertisements on television. Let's see here. Haminesh, understood. I see a lot of videos of traders with opening range break. Yeah. You know, I've done a lot of back testing around opening range breakout sort of things and never been able to make a back test work. I think it's one of those things that the statistical properties of it seem unusual. So maybe there is something there, but the strategy itself is not long-term profitable. In fact, it kind of seems to me that the better play is you have an expectation of order flow. You have expected order flows that day. You can see that we're probably going to break out the top of the range based on those order flows. You get in before the break and then wait for all of those retail traders to come in on the break of the range and then get out off of them. So almost always a better trade that when you're talking about a technical thing like that. Anytime that I see retail traders talking about a strategy and like that strategy gets really popular, I'm looking at, can I predict when that setup is going to happen and get in before that setup so that when the setup happens, I can immediately get out? Does that make sense? Or I shouldn't say, does that make sense? I should say, was my description of that, did I give a good explanation there? I haven't seen any reliability in it either. The crux behind it is that big players place their trades within that one. Well, so that's this is another good point. I think that theoretically the opening range breakout trade is fundamentally flawed because the most activity is in that first hour of trading, and ergo the most opportunity that you have is going to be within that first hour. So like, what if you look at the S&P 500 and you say this is where they open from, and like what does it do most of the time? It's like there's going to be this range and then it breaks out and then like that's the end. Well, in the treasuries this is definitely what it does. But like that high of the day or low of the day is often formed within that first hour. So where the opening range breakout doesn't work is you buy that breakout and then it comes back in and you're just stuck with it all day, right? That's why I really think that the real trade is, if you get this breakout, you've got this range. I think the real trade is I'm expecting order flows to come in long after a certain period. I can get in here. And then when it's breaking out and everybody gets excited, I'm getting out over here. See what I mean? Or an even better way of putting it is this down here was like the volume histogram, right? Right? I want to get in over here when like nothing's going on, when there's like no volume, and then get out when all of that volume comes. I'm anticipating the order flows. I'm predicting the order flows. I'm in before them. And then when I see that order flow, I'm getting out. I'm providing liquidity to them. These guys, they're going to come in. They need to buy a ton of it. How are they going to do that? I'm going to buy it ahead of them. And then when they come in, and they start pushing it up, I'm selling it to them. I'm providing them that liquidity that they need to buy, just at a higher price than I bought it for, right? Whereas if you're waiting over here and you don't get out until it's like broken out and like confirmed that it's going to go higher. So that's the other thing is like, okay, you got a range, right? And then it breaks the range and it comes back in, right? I'm like, what the heck? So what they say to do is you want to see it like break the range and come back and retest and then move up, right? That means that you're not getting in until here. So you've left all of this on the table. And then you get that. And then, well, how do you know when it's coming back? Well, I got to wait for it to test that and come back. So now you've only taken that. And when it doesn't work, like, it's just, it's too small. You're waiting for too much confirmation. So you don't really make money because the amount that you make on that is so small. And then when you lose, it's bigger. Right? You get like this one, you'll get long over here. And then when it fails, it's the one where it goes like this, comes back into the range and you lost that, right? So you can kind of see how the whole idea is kind of a little flawed. But even though there is something to like, there's these ranges and there can be breakouts of the range and key levels, and you will see profit taking ahead of those levels and stops after those levels. And so the key is to know when that level is really actually going to be broken in a significant way and be in long before that happens. That way, you know, if it's a really strong order flow, like stronger than you expected, then you can just hold it and let it keep trending. And if it's not, it's exactly what you expected, then that all of that volume and everything should be a perfect exit point. And that way you're making something that's sustainable too, because your exit is coming out in a place where there's lots of orders coming out and everything. So it's going to be a strategy that scales better. Canada was meant to be the 51st state, says Donald Trump. I hadn't seen that. Okay, so we just had a big move there. It's to the downside. Oh, that is I'm sorry. That is the flash PMIs. So let's see here. We had services 54.3 versus 51, so much stronger than expected. Manufacturing a little weak at 49.8 versus the expected 51.8. So that is slightly hawkish. I don't know if I can pull anything from that. The more I study, the more I move away from any time-based chart. Point being, if I used an hour candle from 8:15 to 9:15, the chart is vastly different than the hour starting from the top of the hour. Yeah. But there's big problems with volume in tick-based charts too. I think if you're doing statistical stuff with this, there's a way to go in and say, like, what is the average volatility at this particular time, and have the bars, like the size of the bars adjusted by that volatility or something like that. But well, I tell you what, there's a lot more volume coming out off of that than I thought. So I think what happened is I didn't have the news squawk going, so I didn't hear when they announced the number. Totally spaced that. But I wouldn't be expecting to see like 5K icebergs down at 21. So that's much more aggressive than I thought. So almost like 30,000 contracts came out there. So on one hand, that's a pretty big flow that has a high probability of continuing through, but at the same time, I think we've already missed most of the moves. So I think that I should probably sit on my hands on this one, especially since I was so slow off of it. But man, Also, what's with that big offer at 22? Finding range. No, range-based charts have huge flaws. Don't backtest on range-based charts. So the problem is you need something that is what we call IID, which means independent and identically distributed. So time is completely independent of price and is identically distributed. The issue with price is that because the key action is concentrated in certain places, right? Well, your indicators and things like that might not be responsive enough when it matters, essentially. But if you do something like range, now you've got something that is not identically distributed. Essentially, it's not independent either, right? Because the range is based on the price. Each bar is the same change in price, so it's not independent at all. And then identically distributed, it's not. And what tends to happen if you build an algorithm and you do some algorithmic fitting on that algorithm, it will fit the algorithm to trading when there is the most volatility, and thus trains the algorithm to trade in situations where the backtester is the most likely to be inaccurate. And so what you get is these amazing the algorithms that look amazing in the backtest and don't translate to live. So that's the problem with that one. So there's better ways to deal with that, I think. The more ideal way, if you're using indicators, which just got to be honest with you. Like trying to predict price with past price on intraday basis, probably a fool's errand. Never been able to find something like that. Not off of only a single price series, okay? But like statistically speaking, the way that you deal with this problem is you get something that adjusts. So like CCI is a really good example. There's a CCI is a great indicator, but then you have that problem with like, it's looking for a certain kind of like frequency of move, and all of that underlying frequency changes. So you have a version of the indicator that is adaptive, is what they call it. Adaptive CCI. And everything that I've seen from backtesting on CCI suggests to me that the adaptive CCI is more effective than the regular CCI. So that's how I would try to fix that one. Apparently, Donald Trump and his advisors are having a meeting this morning. Yeah, what my studies are showing is until a range chart starts printing candles, I shouldn't be in a trade, and only new prints are worth, yeah. Because what you're doing is you're biasing the algorithm towards trading when price is moving. Okay, great. The problem with that is those are exactly the spots where the fills that you're unlikely to get the fills that the backtester is telling you. Like that algorithm will experience more slippage. So like if I'm doing it in ZN, you can go into the NinjaTrader backtester and you can say, give me 2 ticks of slippage on each trade, right? For this one, I would probably do 3 or 4. Like that's the thing is like if you give yourself under normal circumstances, you give yourself 2 ticks of slippage. That means that you can slip 1 tick on both sides, and in ZN that's because you will get way less slippage than that, right? But if you're using range-based bars, then you probably need to do 3 or 4. Then all of this, and you would think, well, that shouldn't make a big difference. But 3 or 4 ticks a trade actually ends up being a big deal. Most backtests don't survive adding slippage to it. But you have to, because that's the thing is that if it moved, right? How often is it in the treasuries where you see it move and then it immediately ticks again? That happens all the time, right? Versus when you get to the end of the bar, it's like it's still sitting there at that bidder offer, so it's a pretty good chance that they can take the market order that they were getting. The backtester doesn't consider the level 2 in there, but so that's where some inaccuracy can come in. That's why you have to add slippage. But on a time-based chart, it's not so bad, whereas with a range-based chart, it's really bad. Well, must say, since we had this, the flash, I don't know if the flash PMIs were that huge, but we did get a strong move down. There was a lot more volume behind that move than I anticipated, but it has moved back to being very, very quiet and tight. So I'm not expecting a lot more opportunity off of that. Let's see. Could be wrong on that. let's see. Let's see let's see what Zero Hedge thinks about the PMIs. This morning started off on the bright side with stocks higher, Trump de-escalating tariffs, and then the Chicago Fed National Activity Index surged 0.18 in February, dramatically better than the 0.17 decline expected. This surge was driven by a big move in production and income. 47 of the 85 monthly individual indicators made a positive contribution, while 38 indicators affected the index negatively, but all eyes were on S&P Global Preliminary's March data for any signs of a rebound after December and January's plunge in services. The good news is that there was a bounce in services from 51 to 54, well above the 51 expected, the 26th consecutive month above 50. The bad news is that there was a sudden plunge in manufacturing PMI into contraction. Commenting on the flash PMI, Chris Williamson, chief economist at S&P Global, said a welcome upturn in the service sector. Activity in March has helped propel stronger economic growth at the end of the first quarter. However, the survey data is indicative of an economy growing at an annualized rate of 1.9% in March and just 1.5% over the quarter as a whole, pointing to a slowing GDP growth compared to the end of 2024. Near-term risks also seem tilted to the downside. Growth is concentrated in the service sector as manufacturing fell back in decline after the front-running of tariffs have temporarily boosted factory output in the first 2 months of the year. Similarly, some of the March upturn in services was reportedly due to businesses picking up after adverse weather conditions had dampened activity across many states in January and February, which could prove a temporary bounce. Business confidence in the outlook has also darkened, souring further from the buoyant mood seen at the start of the year to one of the gloomiest readings seen over the past 3 years, largely caused by growing worries over negative impacts from recent policy initiatives from the new administration. Most widely cited were concerns about the impact of federal spending cuts and tariffs. A key concern over tariffs is the impact on inflation, with the March survey indicating a further sharp rise in costs as suppliers pass tariff-related price hikes onto U.S. companies. Firms' costs are now rising at the steepest rate for nearly 2 years, with factories increasingly passing these higher costs onto consumers. Thankfully, from the Federal Reserve's perspective, services inflation remains relatively subdued, but this reflects the need to keep prices low amid weak demand, which will harm profits. For now, the market is watching the surge in services and ignoring the manufacturing side of the economy. And as we're talking about that, Treasury's kind of kissing the lows again. Very good. To those who blame Biden for the war in Ukraine, what are your reasons and what could he have done differently, asks Reddit. By the time Biden entered office, An invasion of Ukraine was inevitable. If anyone should be blamed, it should be Obama for essentially disregarding Russia's previous incursion into Ukrainian territory in 2014. The 2022 invasion happened because Putin assumed the West's response would be the same as it had been a decade ago, useless condemnation. I'm not sure I agree with that. I think that the timing of it was in part because of the election and everything. And I think that Putin might have thought differently if Donald Trump had been elected instead of Biden. I think that it was like, okay, let's wait for the election. We'll see how the U.S. president deals with us. And then they didn't like the way that the U.S. president was dealing with them, so they went in. I think that the timing of the invasion was basically, let's see how the new administration works with us, and they didn't like how that was going, and so then they're like, okay, then we're going to pull the trigger, and they did it. So I think that there probably was some things that could have been done to have stopped the invasion. Just there were things that the Biden administration was not going to do. So the debate really should be about, should they have done those things or not? It's a big iceberg there they just cleared at 20. There's volume on these ones. Oh, you know what? This one right here we need to fix. It should be like CLK, right? CLK? Yeah. Oh, but that's 2024, wasn't it? CLK 25 should be what it is, but it's not going to pull that one up. I need to update my instruments. Let's see here. Download NYMEX. Blaming any president for Putin's actions is opinion at best. I mean, this is not opinion, right? Like, I was really trying to kind of put more like the context in question, you know? Like, Putin invaded, 2 months into Biden's term? I'm just saying that wasn't a coincidence. They looked to see how the next administration dealt with them and then made their decisions based on that. So the idea that there was not anything that anybody could have done, or that there was not anything that Biden could have done that would have prevented the invasion, I think is objectively false. It's really, of the things that they could have done, were those things that they should have done? That's really what the question is. I would bet that there are very, very few Americans that would be willing to go along with the things that they could have done to prevent it, right? So there we go. Okay. So now we got that. So on these other ones, the 2 and 30. Oh. So there is a spread there. You see in the 2-year? There is a spread. It is tradable. I kind of do plan on someday, I'm always keeping a lookout on it. Someday I think that I'm going to find a way to look at what the main 2-year treasuries are, and the difference between the cheapest to deliver and the on the run, and figure out what that minimum spread should be, which is probably pretty close to what they have. And then, based on a whole bunch of other stuff, determine which side of the market I want to be on and provide liquidity one step ahead of that. And bring those spreads in. That's what I want to do. The 30-year, it's really, really bad. Shouldn't be that wide. So that's why I keep an eye on it. Someday, like the whole thing here is, if we want to make like a market making robot, like do a market making strategy, that's a place where we could do it. We would just have to have an arbitrage opportunity that's good enough to get us a tighter spread than what's being offered. Well, there's another tick down. It kind of looks like that big seller's still kind of there. I was thinking that maybe that last big iceberg was maybe the end of it, but it looks like they've got more. Let's see here. for some reason, Reddit was showing me there's like a general chat channel in futures trading. And so, of course, they're talking about ICT bullshit. And these guys are, the one guy says, where is it? You are either trading the trend, breakout, or reversals. That's what it pretty much boils down to on the basic level. Well, if you're trading off of a chart, then yeah, that's basically your only options. But that's where I'm saying that, like, okay, here's a trade, and it's like it does this and it's a reversal. And this is like a technical analysis setup that they use, and they'll say, okay, once this happens, then I'm going to take a trade, you know, right there, right? Well, you've already missed the trade. The reversal is here. I want to anticipate the flows and get in before that volume comes in and reverses it. Or if it's going up, you know, it's going like this. I want to get in here before it does this. I don't want to get in here when it's clear, right? So when you're looking at that, I'm not really trading it that it's a breakout or a reversal or a range. I am trading it on, I think that there are orders coming, and this is which direction they're going to be, and I'm getting ahead of them. And so there is another way around it, right? The breakouts, reversals range is basically the limitation that you put yourself into when you're trading purely off of price action. Do you know Gary Norton's method? Generally speaking, yes. I haven't gone through his most recent courses or anything like that, but I understand the general idea behind his method. And, you know, I think that there is a lot of cryptic statements and things like that for the marketing. He is teaching something that you're not going to teach that you're not going to learn anywhere else. So I can't guarantee that you make money from it. I mean, with any education, you're probably going to lose anyways. But he is showing you something about the market. He's teaching you an art that's lost. And it is basically market making methods based on utilizing related instruments to determine your value, essentially. So you're coming in and you're saying, like, if I'm trading the 10-year treasury, then I'm looking at, okay, the 10-year ticked down, but the other instruments didn't. That means that this one is out of whack, and I can take fills there and buy it there, or whatever the deal is, right? And well, that's the main idea behind what he's doing. He's usually looking for arbitrage opportunities based on fuzzy correlations between related instruments. Okay, but he goes and it's all in the details. It's like the little teeny tiny details. I think you would see, like, if you're somebody you've never traded before and you went through Gary's course, and you would say, well, none of this really seems like that big of a deal. Like, this all seems like no duh. But that's because you were given all of the answers at the very beginning. If you've been doing it for a really long time and you've been struggling, and then you go and you watch Gary's stuff, and then you're like, oh, well, I was doing this, and now I see why that was holding me back, and I was doing this, and I was doing all these little decisions that you think are innocuous that actually matter a lot, right? But the problem is it's not a cheap course, right? So what do you do about that? Because the issue is I can give you everything that there is, like technical knowledge to be known, and I can give you like all of the the fundamental knowledge that you need to know to be able to interpret the news and all of those sorts of things. Like, I would really like to make a book like the Day Trader's Handbook that has all this information in it. But even with that, the majority of people that try to day trade will fail because it's a competitive thing, and it has to do with like your knowledge of like the current market. Like, are there things that you know, things that are going to happen or are coming? You don't want to be an inside trader, but you do want to know things that other people don't. And that is going to be the thing that determines whether you're profitable or not, ultimately. Or that's the thing that has the best chance of getting you profitable. That's something that nobody can give you. That's all, something that only you can do by having a good network and knowing your stuff and all those sorts of things, right? So, is it worth it to put out tens of thousands of dollars onto a day trading education with that in mind? That's up to you. If you have a lot of money like that, then it's probably, and you're really, really interested in that subject, then it's no big deal, right? But I haven't bought any course. I've only ever bought the No BS Day Trading Beginner course. Booze off to the races, but gold is flat. Yeah, the whole treasury complex is pretty flat. The one that is interesting is the dollar. The dollar had a 30-cent rise and then retracement. So that one's curious. And that is probably from that news, right? Yeah. So it's interesting that the dollar retraced, but the treasuries didn't. So that's a divergence that we're seeing right now. The equities seem to be just off to we're gonna do a bull run today. We'll see how far they get. What I learned, anything can be mimicked. I've seen a synthetic VIX, synthetic dollar index, just to name a couple. That tells me markets can be deciphered. Okay, so how does being able to create your own VIX tell you that the markets can be quote unquote deciphered? That kind of implies to me that there is some sort of underlying message that the market is giving that tells you what's going to happen, and all you have to do is put the right filter on top of it to decrypt that message, and then it will tell you what to do. I really don't think that it works that way. I think that most of what you're looking at, you just have to read ICT messages from beyond the veil. Some Wyckoff. The ICT is still alive, right? But Wyckoff could speak to you from beyond the veil. I don't know. Maybe your guys's you use beyond the veil word differently from me. but for me, that means that they're like a messenger from God, or they're possibly dead. I don't think that the veil gets lifted is when you die that the veil is lifted. Says, yeah. No, you don't understand. ICT's mind spans multiple dimensions. Yes. See, the way that I see it, most of what you're looking at here is random, and there are small little aberrations in the data that might be due to the structure of the market that you can take out. But usually these are already taken out by algorithms. So we can take that information and we can kind of glean what we can from the state of the market based on what the market makers are doing. But that will only get us to break even. So to have an advantage over the market makers, we have to have information that tells us what is going to happen in the future. What are other people going to do without having to rely on a chart, right? Then I can combine my informational inefficiencies. I know that Donald Trump has a meeting today and they're likely to come out on being more aggressive with tariffs, and ergo the S&P 500 should sell or something like that, right? Like that's a sort of setup that you could possibly try. I don't know what's going to happen at that meeting. I'm just kind of giving you an example of something that you might know right now that could be relevant to future flows, right? Then I look at what the current condition of the market is, and I can see like, oh, well, the S&P 500 is moving up and I can kind of see what the algorithms are doing and everything, I might be able to wait for a soft spot in the movement in the hopes that I get a good spot, and then this, flow or whatever is going to happen with Donald Trump comes out and gives me my big win. Right? So I'm combining my informational inefficiency with the market conditions to find a good trade. Is Trump going to crash the market back down? I don't know. I think that the thing that we were hearing this morning was kind of suggesting that Trump was backing off on tariffs, actually. But they're having a meeting today, so I think we'll have a much better idea after today. Basically, not saying we deciphered, otherwise these indices could be mimicked with a code. Well, but I mean, it is all code though. The code is the S&P 500 is an index of all of the individual stocks. So then you have to go and look at what the price of all of the individual stocks are. And the individual stocks, price of the individual stocks is determined by the orders that are put into the limit order book. So the limit order book is, if you put the same orders in, you will always get the same answer out, right? Like you come in today and you put in the same orders, and then they come in the next day and all of the people put in the exact same orders, you would get the same prices. It is determinate. It is determinate. It's not random or anything like that. It's determinate. But the orders that are put into the market are never the same. So what is the thing that changes? It's the orders. If you predict the orders, then you can predict the market. But there's a lot of chaos and randomness to the orders themselves. You see? So this is like really making a solid prediction about where things are going to go is really hard to do without an informational advantage. Elon might be against such a sabotage. I don't know what you're getting at. Like, you asked a relevant question, but you kind of sound like you're trying to bait me into a political conversation. The only relevant information that we have is that the administration is having a meeting with advisors in about 30 minutes. And we will probably hear some slightly different messaging coming out of the administration later today. So let's see what it is. Well, the same goes for DOM ring. There's a market or order flow behavior that you're looking to identify. So there is, I have an expectation of flows, and then I look at the DOM to see if the DOM is showing evidence of that expectation. But me just coming in and I don't know anything, and I just see some strange pattern in the DOM that I think is indicative of the future, and I take a trade, very, very rare. Only when it's like, here's my expectation, and what I saw deviates so far from my expectation that there must be something else going on the opposite direction, right? So we do have to be able to operate in an environment where we lack information, which is where we can that's where like creativity and all of these things come from. Like, okay, we know what we know and we know what we don't know, but what do we not know that we not know? What is it that we don't know that we don't know? And I can imagine things that I might not know that I don't know. Right? And then when I see something that deviates from my expectation, then I can go, oh, that's I don't know what I don't know. I might know what those are, and I might be able to guess and take a trade off of that. Right? But this whole thing that's like, This whole thing that's like, I'm just looking for some set static pattern, and all I need to see is that, and I take a trade now. Not effective from what I've seen. What happened with your Bitcoin model? Good question. I still have it, and I post it from time to time, and I forget to post it because nobody ever says anything about it. But I do post pictures of it on the $3 Discord. And maybe I'll post them later today. Are you planning to stream and comment over? I think that you were maybe thinking that I thought there was going to be a press conference or anything like that, but I don't think that there is. We know that they're having a private meeting in 30 minutes, but we aren't going to be able to watch that. What's this? Amesh? Tesla's business model is a failed model. Elon would be wise to sell to Toyota, Ford. The brand is beyond repair. I don't know. So here's the thing. Again, what is it about? It's about future orders. Okay, so we've got a bunch of people, I think, that are kind of really being activists that are like, we're going to sell Tesla. I'm sure that there's more than one hedge fund out there that is shorting Tesla just for the political considerations, right? So I'm not really sure that I can effectively predict what those future orders are going to be. Is like Elon Musk's reputation irreparably damaged? Will conservatives never make up for, I don't know. The only thing that I know is that Tesla's always been overvalued. Like, it was never worth what the price that it is. Markets are not informationally efficient, so you can't just look at the price and say, oh, well, this is the correct price, and now this thing has happened, so we're moving down. And you could say, well, yeah, we're moving down because that thing happened, and this is what's going on, because we can see evidence of that in flows and people talking about what they're doing. But at the same time, like, what should the fundamental value be? Much lower than it is. I can tell you that much, that it should be much lower than it is. So when Tesla gets to a fundamentally or closer to a fundamentally efficient thing, and then we also consider things like, well, they've hurt their business too. So like then that fundamental value has moved even lower, perhaps. When we get to that point, then what? Is Tesla actually like a failed business? Can they like not continue on after that? Oh, I'm not convinced of that. But would be way too far ahead for me to guess. I can just say that since 2020, I've had many opportunities. There's not a play that I'd ever be able to make on my own account because I don't have a large enough account. But like I went into Thinkorswim Sim and went short Tesla and made a huge on a Tesla short once. Like I've not been going long Tesla. Like I don't care about Elon Musk. I think that their cars are shit and that the price doesn't make any sense. But that's the whole thing, is that it's been like that for years and years and years and years, and nothing ever happened. I'm not entirely convinced that what's going on right now in the political sphere actually has enough longevity to really totally kill it, Yeah, most likely, they come down, Tesla comes back to a reasonable price, and just kind of exists as like a zombie company of sorts. Or Musk divests himself. But I have to say, it really seems to me like the things that are going on are really about damaging Tesla to hurt Elon. And I'm not sure if that's sustainable, right? Or like another way of putting this is it wouldn't take very much of a momentum shift to completely screw that up. Like, I'm going to go short Tesla, and then Donald Trump says, oh, actually, no more tariffs, and the S&P 500 starts to recover, and does Tesla start to recover too? Yes. And there's all of these shorts on it. Yeah. I don't... They're up 9.7% today. Wow. Well, we should come and pull. You know, there's something else I need to come and look at too, by the way, while I'm thinking about it. Here's Tesla on a daily basis. Oh, you're right. It is a bounce, and it's a significant bounce, I suppose. There is like some long-term support where it bounced as well, but not enough on there to tell me something that like CTAs might do something or any of that, right? So I don't know if I can really, but it is a decent bounce, and like could that turn into this sort of thing? I mean, the thing that's so wild to me about the whole Tesla decline is like, hey, like this was the election right here. Right? They're just giving up the gains since the election. Everybody thinks that's the end of Tesla. I'm not going to buy Tesla. I don't think they make good cars, but just saying. There's so many people out there online seem to think they know exactly what's going to go. You seem, Ash, you seem good intentioned, and you're thinking. So I think it's not a crazy theory, but I'm not confident in it. It's not a call that I can make confidently. You don't have an account large enough to short Tesla? Well, dude, who do you think is going to come along is going to be a millionaire to come in here and talk to you on YouTube? Like, seriously. Because you're talking about a stock that's in the hundreds of dollars. So to take a short on it with like options, I'm going to have to pay $30,000 per contract? Like, are you kidding me? Nah, I can't play that one. Can you play that one? You have yeah. There's nothing special, but I'm not I'm not a millionaire or anything like that. But your ability to become rich from trading is actually quite limited. Like, if your filter is, I'm only going to listen to somebody that's a millionaire, what you're going to do is you're going to get a bunch of information that's not even relevant to you. Because you have an unrealistic expectation. Okay, what was the other one that I wanted to look at? Wanted to see if rare earth resources kept going here. Ah, interesting. So there was this one day. Oh, wait. That's not right. Oh, no, it is March. Okay. I was like, how come it's April, May? No, we're okay. I thought there was a day last week where it was jumping up pretty good. I think it was like right here on this day. But it was not. Because I did see some rare earth resources news and stuff. But I don't know. It's cool. We're in profit again. I would actually be way better if I had been paying attention. Because they had an offering and I didn't see the message. And then my basis would have been even lower. But that's okay. Poor people thinking they can do what rich people do is kind of the funniest sales gimmicks ever. Who's buying Teslas, not the mega base? I agree with that. I'm not going to buy a Tesla. I don't think I'm even going to buy an electric car. Because everything that I've seen about it kind of suggests that electric car is not very suitable for my particular use case. It's kind of funny when I go skiing, Because, we're in Utah. There's conservative people, but it's rich. So, there's a lot of very liberal rich people in Utah, just like anywhere else. And, but ain't none of them have electric cars. They aren't taking their electric cars to the ski resort. You get an A+ for honesty. Well, here's the conundrum that I have, Shame, is am I saying that right? Is that I want to teach you guys things about the market. I think that there are some important things that we know about the market that the larger society can benefit from. That's the video that I'm going to be putting out today. The video editor is still making changes to the... I think he's still uploading it. I think maybe his internet's just slow. Okay, that's what that video is going to be about, is some economic information that is we need to get more people interested in. And that information can inform your trading, and it can give you a better chance at trading. But the reality is I can give you all of the best information that there is, and you're still likely to lose. And that's because the things that really give you an advantage are not things that I can just give you. They're things like your network and your existing knowledge and things like that. That are going to give you an informational advantage and allow you to predict what other people are going to do before they do it. That's what you're really trying to do into trading here. So, right, I can only do so much. And everybody assumes that because, like, we're doing day trading here, that I'm giving you some sort of technical setup that's going to, if everybody follows it, they're going to make money. And it just, the whole thing doesn't work like that. So if there's any value that I can bring, it's like, helping you understand the game so that you can decide if that's really a game that you want to play or not. Because the reality is most people are going in and trying to do something that is just absolutely crazy, that they think that they're going to be successful with that. It could save them some time. But everything that I'm teaching you is backed with empirical evidence, and you're going to understand the market on a level that few people in the world do. I read a story recently of a guy in Montana with his electric car, and he couldn't find a charging station, so he had to rent a car. That's funny. Well, the two stories that really saw before, I remember maybe, let's say 2017, maybe us talking about this and being like, well, I kind of don't want to pay for gas anymore. So there was a period where I thought, hey, maybe I would love to have an electric vehicle and everything. But then what happened is I learned more about them. The first one was understanding that, like, most homes don't have the infrastructure. Like, you basically, you have to, like, overhaul your electrical in order to have like a charger in your house. So that was the first big, if I can't charge it at my house, what am I going to do? There's some places where at your workplace you can charge it, then maybe it would work. So that was the first one. And then the second thing was finding out that the quality of the cars is just not very good. Everybody makes it, it was. I remember when I was looking for a house, so that was 2017, I think. And like the realtor, they had a Tesla. Like that was the thing that everybody did to show that they had money, was to get a Tesla. And but then I found out that the quality of them, the build quality of them, was really bad. So that was the second thing. And then there was like these two major stories that really made me be like, I will not. One was when we had freezing winter in Chicago, and people had to just abandon their cars in the parking lot or on the street in some instances because the batteries couldn't handle the cold temperature. And then the other story that I heard was when there was flooding in Florida and Teslas were like exploding because they got wet, because they got flooded by seawater. So those were the two things that kind of said to me, I don't know if an electric vehicle is really very well suited to my particular use case anyways. And then it was everything else on top of that, like that we don't really have the infrastructure to be able to have everybody be in an electric vehicle. I'm kind of of the opinion that hydrogen will take off at some point, and that everybody will use hydrogen cars. That seems like more promising technology to me. But who knows? By the time that comes along, then probably there will be all these things about hydrogen, and I'll know more about it, and I'll be like, nah, I don't want hydrogen either. Right? Okay, well, I am going to end just a little bit early. I do have an appointment to get myself ready for here, so I'm going to do that. The whole Tesla thing and liberals switching on Tesla just because Elon Musk supported Donald Trump, and the whole thing is just a crazy storyline. You can't write this stuff. You can't make this stuff up. And I can't predict what's going to happen. I really can't. I'm sure that there will be more wild and crazy turns in the Elon Musk saga. I look forward to it. This is my entertainment. So, I'll see you guys tomorrow. In the meantime, stay excellent, team.